Underground, overground, wombling free. Wombles of Wimbledon, coming are we. Oh, hello boys and girls. No, we're not doing play school today. We're going to do the charts, coffee with Scruff. A little bit of a different one this. Roll the intro and I'll tell you. And a warm welcome, one and all. What we're going to do is we're going to look at a couple of comments from some of the videos. Now the first comment is from an older video that I did on fibs a while ago. Now I love fibs and I'm only going to glance over it, but the reason why I'm pulling it out is because I think it's dangerous. And I'm kind of give you a couple of thoughts on what I thought. I also think it's stupid as well, to be honest. And the second one I think is quite interesting. But it's interesting on two levels. One, it's about how you're looking at the charts, but then it's how you feel about the charts. And I'm going to have a little look at a chart and see if I can break it down somewhat and help the guy, because I genuinely want to. But first of all, I'm having a coffee, because we all know Scruffy likes a coffee. And after this weekend, I need one. Oh, I've had the grandkids all this weekend, and they've run me ragged. It's lovely to have them, but they smashed the house. We had to go to various different events just to keep them amused, and I've just come to a conclusion. I'm getting too old for this shit! But let's get into this. So this is the first one. This is from a video I did about 4 months ago. And this comment came in on Friday. And I often say, in fibs we trust. Why? I use them every day. I've used them for over a decade. They're well known, they're repeatable in nature, and they're one of the few tools that is reasonably predictable. Why? If you've got a fixed top and bottom, if it breaks the 23, it's looking for the 38, breaks 38, it's looking for 50. Why? Because 80% of the time, it will retrace to 50% from a strong directional drive. This isn't my findings. This is well documented, and it's been well documented for decades. So yes, in fibs we trust. But there's a comment underneath saying trust is a dangerous thing when trading. That is one of the dumbest comments I've ever come across.
Oh, here we go.
No. Now let me explain why. If you don't trust what you're doing, why the hell are you doing it in the first place? That means you're nervous. That means you're frightened and you don't trust it. So how can you build a plan around that? You can't. Now, people who say that are normally gamblers and chancers. If the chap is, brilliant. And if he isn't, I really wish him well in his ventures. But to say trust is dangerous in trading, it's wrong. You need to trust what you're doing. Now, there's a number of elements to this. You need to trust yourself. You need to understand what your psychology is. Can I trust myself to press the button at the right time? If you can't, you need to work on that mindset and what you're sort of looking at. Do you trust the system that you're using? You could flick a coin, but have a very good management system you trust. So therefore, the entry is important, not as important as the management, but you trust the management system. Or you can have it the other way around. You can have a system that you trust that works more often than it doesn't. So therefore you trust its edge. I'm not going to spend too much time on it, but what I'm going to say is very simple. If you're going into the market and you don't have trust, you don't want to be trading. And you certainly don't want to be listening to that sort of advice. That is the dumbest thing ever. You need to trust what you're doing. Period. And it starts and ends with you. So look in the mirror and ask yourself, do I trust this person? If you say yes, why do you trust this person? I make logical decisions. I'm rational. I don't gamble. I understand the system that I'm using, and I understand the amount of money that I have, and I trust the process. Tell me I'm wrong. drop it in the comments. I'm always interested. It's not to pull apart, and it's certainly not to pull apart the chap. But what it's to highlight what you should be doing in trading. And trust is number one. You need to trust what you're doing. If you don't, well, you're probably going to find yourself in a lot of trouble.
You're in big trouble, mister. And I mean trouble with a capital T.
Now, the next part, if you bear with me half a second.
Well, we're waiting.
Okay, guys. So a couple of days ago, I did this particular video here about how to identify trends in a basic form as part of the Ask Scruff series. And as usual, the comments come in. And I do implore you to comment, because even if you're commenting on very old videos, I'll still answer them and come back to you. Now, in it, what interested me was this particular one. I did respond to it. PacFan 786. And it's an interesting comment because of a couple of things. So the first part that caught my eye was this bit here. The markets are clearly manipulated against you. Are they? Yes, they are, but not in the sense of they're seeing your orders coming in and they're genuinely trying to stop you from trading. Because for most retailers, we're insignificant. They wouldn't even know that we're here. But then what we've got to look at, so he entered at 13,080 and it created a resistance level here and reversed 30 pips. And you had to call in reserves. That kind of worries me a little bit as well. Depends on what your definition of reserves are. If you're staging into a trade, then fine. You know, I stage trades all the time, but I only go in with a partial entry. I don't go in with full position and then add to it. And this is a misconception about what I do. I go in very small and I build up to the big position. So I'm actually have a less loss than somebody who's a traditional trader. So I have less exposure, but a greater upside. But if you are just adding to a full position, that is very dangerous. And then it had the news, jumped back to 130.80, and then it backed down 3 times and never broke. And then closed the day at break even because of boredom. Okay. There's quite a bit to unpack here. So I've got a chart here. And this particular chart, it's fully marked up. And I've put a little line in here. Now that line, that green dotted line, see if I can just change it into something else. There we are. Okay, make it a bit bolder. All right. That represents the entry point. So there's a couple of things that I need to look at. Now, if I'm going to critique this, and personally I prefer to trade forwards, and that's the way I do it. I don't like going retrospective into a chart. I prefer to analyze it and then you see what I see. And that's why you see my trades alive. But this one we're going to have to retro engineer, but you'll be able to see it. So first of all, the first entry point to break this green line at the price that we're talking about is here. This is at 9 o'clock in the morning. So I can only assume that the chap was wanting to go long, which is fine. Well, the first thing in my mind, and this is an hourly chart, by the way, and this is where you want to be sort of getting a good idea of your signals and etc., is it actually worth going to market? Well, the answer is no, because directly above it is a strong area of interest. And these are high concept interests. And if you know where these levels are drawn, and they're a combination of support and resistance, swing failures on high time frames and high time frame fibs, there is nowhere for that price to go. Even looking on this hourly chart, looking back into history, it would have been coming into a solid cluster point anyway. So I'd be very wary of entering a market at this point. If I was wanting to go long, it's too close to a level I would need it to relax. Okay, so that's the first thing that I would pick out. Now, the next part of it is why would you take it? I can kind of vaguely see why. We've got to push up, come down, bounce, and then a solid surge up. But what is that surge? Well, it's the 8 o'clock open. And it often goes the wrong way before it goes the right way. So that there, again, would be quite dangerous. Okay, but let's break this down somewhat. So the first thing I would have done is, we know there's a news announcement at 1:30. Is I would look at this. Now, this particular setup, I haven't changed the settings yet, although the date is for today because it updates the date as it goes. But these are the settings that were there on Friday. Actually, bear with me half a second. I'll be able to show you exactly what Friday's was, because I would have had it in the Discord on Friday. So let me just flick this over, just so that you can see it. So if we go back, Friday would have been the 11th. There we are. So 49, 14, 49, 14. So there you go. You can see the scores are exactly the same. It's just I haven't updated the sheet yet. It's just so you know that I haven't manipulated this. Okay. What was it telling me? It's telling me the pound is very weak. It's telling me US is pretty darn strong. Pound had lost ground. US was losing ground as well, but still stronger. But the strength of it was telling you the pound is going to struggle to get higher. Why? Because it's losing ground against the US that's still relatively strong. So that was the first thing. Okay. Is that for direction? No, not so much. But it would give you an idea. So where would I go from here? Well, the next part of it is, before I'm even looking at this, I want to start working out biases. Well, if you come out to the daily and you looked at that particular chart, where would you say it was going long? Well, you wouldn't, because it is clearly more pressure to the downside. See it here. What else is it? Well, it's actually coming down onto this level here. So it's a full retracement it's looking for. It's already tested it. A little test. That is probably where it's looking for. And funny enough, on that day, it did. But if it's breaking down, it'll start looking to come down into these levels here. Why? Against this particular move. But this is a daily chart, can take some time to get there. But you do want to work on the premise of the dominant direction. So let's look at some basic indicators. Basic stuff that everybody can see. Well, there's a Bollinger Band. The Bollinger Band on the daily is clearly telling you this is going down. How do you know? Because it's flaring to the downside. It's holding below the moving average, and the moving average is curling over. Now, the moving average through a Bollinger Band is a 20. So it's a standard moving average everybody can recognize. It hasn't broken outside the Bollinger Band, and it's flaring both sides, telling you pressure is that way. Okay, so I've got another piece of information. So I've got the strength telling me the pound's having a hard time of things, and I've got a Bollinger Band telling me it's having a hard time of things. Okay, so what else can we look at? Well, what's the next basic? Say a MACD. MACD are very good at giving you general direction. Clearly down, pushing down. Okay, so get rid of that. What about an oscillator? Well, RSI is a good oscillator. Well, what do we know? It's coming from the top and it's working down. So you've got three indicators telling you this thing is moving down. You've also got a strength sheet that's telling it's moving down. And you would have found that on FinViz as well, by the way, guys. Okay, so this is your homework. So your homework is clearly telling you this is probably selling off, or you're better off selling than buying. Okay, So you come down into your hourly chart. And this is kind of where your action is. So let's just draw a line at the start of the day. So it's kind of down here. Well, if I'm coming into this market and I already know that I'm looking to sell it, do I sell it low or do I sell it high? Well, you look to sell it high. So what you're actually doing is you're entering the market to go long when a lot of people will be looking to sell. Now, there is something else that's against you as well, and that's the time of the day. It's Friday. So what else can we do? Well, even if you're looking at this, you can kind of see it's on a downward slant. Take a trend line and just follow a trend line through prior day. We'll thicken that up a little bit for you, just like so. So there's a prior day trend line based on the general direction you're going in, and you can see it's progressively moving down. Well, what did it do? Went up to try and test it, did test it, and then sold off back down again. I wouldn't say this is manipulated. I would just say it's misanalyzed. Now, that was the strong move. But if you wanted to go long, and you can go long on both days, there are ways that it can be done. Now, this particular hour is dangerous. You know, I know there's a lot of people try and trade the open, and personally, it's too heavily money flow to predict. So it's kind of a gamble. It's a time cost. But if you get a fib, and I like fibs, there's a clear move from the day before here. Okay. You also have in it key areas of attraction. So you've got one here, which is your 50. Got another one directly above it, which is there. And then here, and then back down again. If you wanted to go long without pushing into the market too much, you've got some key areas that would have helped you. And it's that one right there. And why is that? Well, let me show you. Let me draw that in just so you can see it in case you forget. Okay. Markets work all the time on ratios, and they will retest into the center over and over. Strong directional drive, 80% of the time, will come back to 50%. Well, do you really want to be buying in the top of the market? No, you want a better price. So you could have started to buy in and around the 50, waiting for the retracement to come down, nice pending order, and then straight up to come back to actually where close on where you were trying to get in. Now, you've also got the news event, which was in amongst this, which is here. And again, that there could have been dangerous, but there it is there. Came back round, you had another bite at the cherry, and then you come back here. But there's something that is incredibly worrying, and that's the bit we're going to end on. Now, kind of critiqued it a little bit just to get an understanding. The safer trade was the sells. Okay. Why? Because you're going with the flow of the market. The next part of it was marking up, understanding, and analyzing the chart fully. All right. Are decisions made on hourly, 15 and 5 minutes? Not really, no. Your decisions are made higher up in the chart, your dailies, etc. But then you talk about the day itself. It's Friday. It's a bad day to trade. And once you go past 12 o'clock, the markets slow down to a crawl. Yes, you're going to have news, which will spike it up a little bit around 1:30 through till 3. But once that's over, the market's dead. You know, Because you've got to remember, the people that are operating the markets are guys like you and I. They just want to clear their desk and go home. They're not really looking to do much more. So when you next sort of think, oh, the market's working against me, always remember, they don't even know you're there. You know, they'll have a fair idea in and around levels where things are if they want to push and get a better price. But a lot of the time, it's just the market doing what the market does. And you've read it wrong. And you're chasing the market because you're looking at too low a time frame. And when you see minute chart traders, even 5 minutes to that degree, but only taking their levels from that area, they're probably going to be wrong, because those levels mean nothing to the market. Zero, zip. The big boys that can push and move the markets around, they're looking at levels way higher in the charts, and those levels will ripple through time. So you can draw a monthly level on, and it'll be in exactly the same place on a minute chart, but it'll hold a damn sight more weight than a 15-minute level that you can see from 2 or 3 hours ago. That means nothing. Zero, zip. So where do I end this one off? I don't think what you did was wrong, but I think your idea of looking at the market maybe is. Nobody was manipulating against you. They wouldn't even know you're there. Looking at your price point of entry, I think it was too close to a key level. And if you were going long, which is what I suspect based by the comment, you were looking to buy at the top of the market when it was dead flat. So just a thought. I hope this opens your eyes a little bit. I'd be interested in your thoughts. Some will slag me off, some will pat me on the back or whatever. Don't really matter. But that's my view of that chart. So as always, guys, do what you love and the money will follow. See you all in the next one.